Mate, the gold out. Is it a safe haven or a short-term trade? And why does your portfolio need a shiny rock? Good morning. The most single boring question I get asked right now is also the most pressing question. What's my outlook on gold? Hi, my name's Jessie Colvin. I'm a financial planner and certified technical analyst. And today I want to talk about that nice shiny rock and that everyone is lining up for in Sydney 2 hours, and if it's important and if you need it. My answer on the outlook remains structurally bullish, which is a fancy way of saying it's probably going to go up eventually unless something wild, unexpected happens, which also always does happen. But seriously, we've been seeing gold setting record high. It's not just a market glitch. It's not the gold buggers finally winning. It's driven by powerful fundamental forces that are the investment equivalent of that one house plant that you can never kill. Believe me, I've killed a few. There are 3 reasons why gold is the financial equivalent of a panic room. We have 3 key drivers supporting this long-term trend, or as I call them, the 3 horsemen of the golden apocalypse. The first one is geopolitical uncertainty. Gold is the world's ultimate insurance policy. As global tensions, trade conflicts, and political instability rise, people inevitably think, what's the one thing that will be still valuable when the internet goes down and bartering livestock? The answer is gold. It's the original asset. The second one is the central bank demand, the big buyers. This is massive. Central banks, especially in emerging nations, are buying gold at historic, sustained paces. They are finally looking at the US dollar and collectively thinking, I'd like to diversify away from that, thank you. It's a massive institutional vote of mild mistrust in the current world order, and it puts a very high, shiny floor under that gold price. The third one is monetary policy. Interest rates died. Gold doesn't have to pay interest. It just sits there looking pretty. That's the problem until central banks start cutting interest rates. When you can earn next to nothing on bonds or savings, gold's lack of yield suddenly looks a lot less flawed and more like charming consistency. An opportunity cost of holding in gold shrinks. It's a financial version of if you can't join them, look better than them. Yes, there is volatility, there is pullbacks. You should expect them. Think of it as the market's way of reminding you that you're alive. But the consensus from major financial institutions is that gold will continue to climb significantly in the coming years. Now, there's 2 paths to also look at this. You're either a trader or investor, and your strategy must align with your goal or you'll end up stressed and broke. If you're looking to make money on the short term, you're a trader. You're playing very different, dangerous game. You're not an investor. You're a highly paid and highly caffeinated speculator. Traders tend to focus on catalysts. They need to watch the daily drivers like hawks, like a field mouse. Suddenly shifts in the US dollar, inflation reports, Powell speaking, interest rate cut expectations. A single poorly worded paragraph from the Federal Reserve can make the market hundreds of dollars go up or down in one day. You need to be ready to sprint at any time. The second is they use quite liquid instruments. So they're not buying physical gold when you're a trader. They're buying gold EFTs, futures, contracts, companies, mining stocks, and they need to be able to get in and out faster than a politician changing their stance. A trader is generally ruthless with risk. You must be agile, ready to admit that you're wrong, and most importantly, you need strict stop losses. If you can't handle losing 5% of your capital in a single hour, then it's not for you. Go buy a nice mutual fund and then go get a hobby. Second strategy is the long-term investor, the patient prepper. This is something that I'm really passionate about, and this is how I invest. For the rest of us, your mindset should be entirely different. You're not chasing quick gains. You're focused on wealth preservation and proving you aren't completely crazy to all your friends. Think of gold as a hedge. It's not a growth stock. So gold would be something that would be quite safe in your portfolio. It's a permanent, slightly dusty part of your financial defense system. The asset that's meant to hold its value when your tech stocks are going all over the place. Think of companies like Nvidia and Google, and yes, they go up, but they can be quite volatile. Generally, gold is quite a safe asset. The second strategy is a systematic accumulation. That's the boring but effective way. The best long-term strategy is dollar cost averaging. Buy a fixed amount on regular intervals, and it takes the emotion out of investing and is much cheaper than therapy. The third is buy the dip. It's a strategic shopping spree. When you use significant price pullbacks, say a 5 or 10% pullback on gold, that would be an opportunity for you to strategically add to your portfolio. Don't panic, just think of it as gold's on sale, there's a 10% discount. The fourth is to make sure that you're getting proper allocations. Don't go all in. Most experts recommend keeping your gold exposure within the 5 to 15% of your total portfolio. That's enough to provide crucial hedging without making your portfolio feel like you're just relying on precious metals for growth. In summary, gold is shiny because the world is a wonderful, volatile mess. If you're a trader, you need to be agile, caffeinated, and follow the feds like they're a boy band. But if you're a long-term investor, stay patient, accumulate, consistent, and let the gold play its historic role in your portfolio's silent, unmoving, and thankfully non-digital rock. Who wants to look on my altcoin on Bitcoin? Nah, just kidding. I need them.